Hey y'all, I'm Barbie, and you may know how I feel about indicators. More indicators, more problems. But even I can confess that there is just something about MACDaddy, MACD. He's been around since the 70s when technical analysis was just starting to take off and the very first computerized charts were even created. So since space on your screen is highly valuable, any indicator that you add needs to be really useful. And the MACD is designed to help us see strength, direction, momentum, and even duration of a trend. Sounds pretty useful, huh? Well, what it's not is a standalone signal. So traders use it to find confluences and divergences in the market. After all, MACD stands for Moving Average Convergence Divergence. A moving average is a line that smooths price by taking the average over a defined period, like 9, 12, or maybe 26 bars. So at its most basic, a moving average can help us see a trend clearly in the noise of a candlestick chart. So an SMA, or a simple moving average, just literally takes the average price over however many bars in the period. So an EMA, or exponential moving average, also takes an average price, but it's going to weigh the most recent price bars higher than the older bars in the period that you have it set to. So the most recent candle's price is more important to the EMA than those from, 6, 7 candles ago. The idea is that an EMA will pick up on a change in a trend sooner than an SMA. So what's that got to do with all these squiggly lines at the bottom of the chart? First, we're going to start in the price chart and I'll get us back there. But let's focus on the EMAs. They can help us to clearly see trends. And if we take, say, a 12-period EMA and put this on a 5-minute S&P futures chart, we can see the general trend in a smoothish line. A 12 is a pretty fast moving average, and a clever way to see the change in a trend is by comparing a slower and a faster EMA. So let's add a 26. 26 is slower to react because it's averaging over more periods or candles. So the 12 EMA is covering less than half of the candles. So it's going to react much faster. The farther apart these two EMAs move away from each other, the more the trend is increasing. So as the trend starts to end, they're going to start coming together. We can maybe see this in the price action, but these EMA lines make it a lot easier to see. So when they cross, it's a sign that the trend is changing or reversing. Well, our guy, Gerald Appel, was clever, and he thought to pay attention to the difference between these two lines. So if we take the value of the faster 12 EMA and subtract the value of the slower 26 EMA from it, we can quantify this trend. And in an uptrend, the faster EMA will be higher, so we'll get a positive difference. And if it's in a downtrend, it'll be negative. And that's where we get the MACD line. The MACD is that difference between the two EMAs. So when you go into your settings, and I'll show you what the settings look like for both TradingView and NinjaTrader, the 12 and the 26 are the defaults in most software, which is why I chose them earlier. This line will have a steep slope and a strong trend, and we can watch for the strength and the rate of the change in the trends when we're looking at this line. But we don't just put moving averages on price though, right? We can also put moving averages on indicators and other calculations like the MACD. An exponential moving average on the MACD will smooth the trend over the average of the last period, which is typically set to 9, but of course you can change that. And this will help us see the changes in the trend more easily. And now we have another set of lines that we can use to watch for a cross. And it's called the signal line because this cross is considered a signal to pay attention, not necessarily to click the button. Stay with me. If the MACD line crosses above the signal line, that's potentially bullish. Crossing below is bearish. So when we combine this with something else that we can find confluence with, like key levels or pivots or structure breaks, whatever, then we have an entry strategy. So more on that in a little bit, but first, it's the Moving Average Convergence Divergence indicator. Convergence when these lines come together, and the divergence when they come apart. And that's where the histogram comes in. So if we take another measurement and we compare the MACD line to the signal line, we can compare how close or far apart these lines are. And we can quantify this by subtracting the signal line value from the MACD value for each bar on our chart. If we plot that value as a histogram, we can see a visualization of that difference. So what is this showing us? When the lines are converging, we'll see the histogram move away from the extremes to the zero line. And when they're diverging, we'll see them expanding away. The stronger the increasing strength of the trend, the larger the histogram plot. That shows us the increasing trend strength. So when they start converging, we'll see a trend weakening as the histogram returns to zero. Some platforms will even differentiate between the two colors on the chart when the histogram is increasing or decreasing, even though you can kind of see that. But knowing when a trend is strengthening or weakening can help us with entries and exits, right? Watching for crossovers when the MACD and signal line cross, which will also show a histogram cross, can really help us with both entries and exits. It can help show us changes in strength and direction. Pretty handy, right? It can also show us divergences. So think of this as kind of a little bonus play. But if we see price moving in one direction, but the MACD moving in another, that's a warning sign. We really need to pay attention. When a chart is oversold and we see a bullish divergence, that can give us an entry. Another strategy is to watch for the changes to waterfall across different time frames. So if the MACD is switching to bullish on the 15-minute and a 5-minute signal is also there, we have confluence. Sometimes we'll be waiting for a larger shift in trend, kind of a longer day trade, and we'll see it begin to appear on lower time frames like the 5-minute before it starts trickling up to the 15 and the 30 and the hourly. And that will kind of let us front run some of these entries at key levels or pivots for some of these longer day trades. Index traders can also watch for confluences between the futures chart, like the ES S&P 500 futures, and the underlying ETF on the SPY chart. So while I appreciate that space on my screen is at a premium, I'll throw MACD on some of my charts for entry and exit confirmations. And bonus fact, did you know that many other indicators are based off of the classic MACD, MACDaddy, like the TTM squeeze, and of course, the multi-time frame Mo roll? But drop a comment and let us know if you use the MACD or not, and what your go-to MACD strategy or any other favorite indicators are. All right, until next time, love you. Bye.